Hey, what's up everyone? This is Trading Coach this side, and in this particular video we are going to discuss about Wyckoff trading methods. Alright, so this is a set of video series, and in the particular video series we are going to talk about the trading techniques of the legendary trader Richard Wyckoff. We will try to understand the concept, the terminologies and the ideas as well as the trading strategies given by Richard Wyckoff in a set of video series. So in this particular video, we will talk about the so-called Wyckoff market cycle, and we will try to understand the 4 stages of the market cycle, the so-called accumulation phase, distribution phase, markup phase, as well as the markdown phase. Alright. So before we do that, as usual, I recommend you to hit on the subscribe button, tap on the notification icon, and in case if you like to know more about me, visit my website, that is www.tradingcoach.co.in. Let us dive into the topic. Alright, take a look at this particular diagram over here. So this is what we call as the Wyckoff market cycle. So as per the legendary trader Richard Wyckoff, the market usually moves in 4 different phases. Alright, we will see 4 different stages of the market at any point in time. So it doesn't matter which instruments you are looking at, whether you are trading in stocks or whether you are trading in commodities or currencies or cryptos. Whichever instrument you are trading in those instruments at any point in time the market will be in either one of these stages. Alright. So the so-called 4 different stages are the accumulation stage, where you will see a kind of a sideways market or maybe a kind of a range bound market. It could be a downward range or an upward range. And right after that accumulation phase, the prices will break out and move into a kind of a markup phase. And right after the markup phase, once again the prices goes into a range or a sideways market behavior. And right from that sideways market behavior, we call it as distribution phase. And right after the distribution phase, the prices are likely to break down and it goes into a kind of a markdown phase. So as per Richard Wyckoff, the market usually follows these different stages or different phases like a sequence. But as per my experience, what I have learned is that the market doesn't have to move according to the sequence. Alright, what I have seen in the price action is that you will see an accumulation phase, but right after the accumulation phase you will not see a markup phase. Instead you will see a markdown phase. Alright, the prices goes into a distribution phase, and right after the distribution phase you will see a kind of a further uptrend instead of a downtrend. So all these kind of differentiations, all these different variations of the market cycle can happen in real life. So even though Richard Wyckoff pointed out the market goes in this type of stages like a sequence, it doesn't have to be the case in real life, because we see that during the time when Richard Wyckoff came up with this idea, it was, I guess it was during 1920s or 1930s, and today the markets are more complicated than that. Markets have evolved a lot, so the same sequence does not apply. Alright, so being said that, the next most important thing is, whenever Wyckoff analyzed the markets, he usually looked at the prices in correlation with the volume. So he combines both price as well as the volume to understand the market. But in case if you don't have access to the volume, which is the case with most of the trading instruments, especially if you are trading in commodities or if you are trading in currencies or indexes like Nifty, Bank Nifty, you cannot have access to the volume. Volumes are completely unreliable in such cases. So in such kind of circumstances, we can just use the price. Alright, we can just rely on the price action and we can take decision just by looking at the Wyckoff structures on the price action. Alright, so when we are analyzing the stock, we can combine both price and volume. On the other hand, when we are analyzing other instruments, we can look at just the price itself. Alright, so in case if you are pretty new to Richard Wyckoff trading techniques, if you want to learn more about Richard Wyckoff, you can also visit my website. In my website, I have a specific article, an article that's completely related to the trading principles and philosophies of Richard Wyckoff. So I recommend you to check out that particular article because it gives you a brief background about Richard Wyckoff. Alright. So just to explain in a nutshell, Richard Wyckoff is one of the most successful technical traders. He is one of the most richest technical traders during his time, and based on his techniques, he identified some good moves in the market. He made very good returns, he made very good money in the markets during his time, and the same techniques we are going to explore in a series of videos. So if you like to learn more about him, check out the article. I will leave the link of this particular article on the description box. Alright. So another most important and the interesting aspect of Wyckoff trading technique is that when we use Wyckoff approach, we think about the markets from the perspective of the so-called big players or smart money traders. Alright. So the core concept of Richard Wyckoff was to identify the activity of large market players and taking positions along with the activity of big players. Alright. So he usually understands the market through the perspective of big money traders. Alright. The so-called institutions, hedge funds, mutual funds. So they are the ones who move the market, and Wyckoff approach is to understand the markets from their perspective. So when we do that as a retail trader, we can get some significant edge in our trading process. So you might have heard about some of the common terminologies of Richard Wyckoff techniques, such as the so-called accumulation phase, which is over here, right? And you might have also heard about another important concept, the so-called the distribution phase, which is also a part of a market cycle. So right after the distribution phase, the prices are likely to fall, because as per Richard Wyckoff, distribution phase is where the big traders or the institutions are actually selling the stock, right? They are selling the stock from their portfolio to the small traders, okay? And the accumulation phase is exactly opposite of that. This is the phase where the big players are actually buying the stock from the uninformed retail traders. Alright. So the people who are not aware of the market, they are actually selling the stock, and the so-called big players are buying the stock in these type of circumstances. So Wyckoff dedicated much of his time in identifying these accumulation and distribution phases. So we will discuss about these different terminologies in upcoming videos. So being said that, make sure you hit on the like button, and in case if you have any questions or if you have any queries about Richard Wyckoff approach, just leave your questions, or leave your thoughts on the comment box below. I will try to answer them. So in the upcoming videos, we will explore more about the different stages of the market cycle. We will look at each one of the stages in depth, and we will see how we can trade them, right? So until then, thanks a lot for watching, and happy trading.